Hi there, I'm Lindsay Biscaya. Welcome to Market Call. John O'Connell is on the show today. He's CEO at Davis Rea and will be taking your questions on North American large caps. Here's how you can reach us. You can call us toll free, 1-855-326-6266. And you can send us an email as well to marketcall@bnnbloomberg.ca. And John joining us in studio today. It's good to have you come in.
Thanks for having me on.
Yeah, so we're obviously watching the developments in the Middle East today pretty closely. Oil, energy prices surging. Do you see this as kind of long-term volatility, or do you see this as kind of a short, I think you say a short war scenario?
That's, I think, what most people are discounting. You know, energy prices, let's say a year out, are significantly lower than the spot prices are today. You know, interest rates aren't, you know, there's not any major changes in interest rates. There's no major shifts in currency. Gold obviously is reacting to some extent. Bitcoin's reacting a little bit as well. But I think, you know, really most people are looking at the results and saying, you know, they have tremendous superiority in the air. They don't want to go on the ground. Whether they can affect regime change or not is an unknown. But I think most people sort of think that this is likely a pretty short occurrence, and things should return to normal.
You say the real risk isn't the Middle East, but the opaque private credit markets. What do you mean by that?
I think so. I mean, you know, I think most people think that the war will be relatively short. I mean, let's hope it is.
Yeah.
There's been a lot of concerns. You know, bank stocks were down 6% last week. Private credit stocks are down 30, 40, 50%. You know, they've been trying to sell these specialty funds and stuff into their individual investor network, thinking that, oh, they don't care about liquidity and the pension funds don't care about liquidity. And there's a lot of unusual activity and there's a lot of lending going on. And a lot of lending took place when interest rates were significantly lower than they are today. And the question really is, have people lent money to solid businesses? And will they be able to pay those loans back? And, you know, they're private credit, so when people do need to arrange for liquidity, when these funds do need liquidity, when the panic ensues, there are no easy buyers for these assets that these funds may have. So we're seeing a concern about that. We're seeing like an AI, I call the AI temper tantrum, in that people are worried about mass job losses. There's kind of a hysteria that software is going to go away when in all likelihood there's going to be even more software. We'll need more software engineers to write all this software and manage it and integrate it into people's lives. And so people are worried about mass job losses. Will the economy go into the tank? But the exact opposite is actually happening. We're seeing increased number of software engineers. We're seeing a very robust economy. We're seeing very robust corporate profits. We're seeing very robust employment statistics right across the American. We're seeing lower interest rates. We've seen a short-term spike in energy prices, which is a tax on consumers. But it's not really expected to last a long time. And I think it's instructive to note that even with the energy prices up, let's say 6% today, that's lower than they was in June of last year when they had the first attack.
Right.
So, you know, markets tend to adjust to these geopolitical situations pretty quickly. I mean, you know, when Russia invaded Ukraine, there was a great deal of turmoil, and then things sort of started calming down, became part of the daily narrative. I think that's going to happen. But, you know, if you look at what's going on in the markets on the surface, there's been a lot of destruction of value. There's a great deal of value that's been created because of panic and job losses, about AI eating the world and us all becoming subservient to a computer, which I think is, considering nobody was thinking about that 3 weeks ago,
Right.
that we now have such hardened opinions of it.
Yes.
It seems that maybe the people that are driving this narrative aren't necessarily long-term investors, but more computer-oriented trading platforms and programs. And I would say that AI has gone a little bit haywire.
Okay, we're going to take a quick break right now. We will be back with John O'Connell of Davis Rea, taking your questions on North American large caps right after this. Stay with us. Hi there, welcome back to Market Call. John O'Connell is on the show today answering your questions. We'll start with email question, this one coming in from Carter, and it reads, what does your guest think of Brookfield Corporation? Short and sweet, what do you think about this company?
Carter, so Christine Poole, my colleague at Davis Rea, owns Brookfield. It's really a great Canadian success story. Brookfield Corporation that owns some of the investments, and then Brookfield Asset Management, which is sort of the management company that makes all the investment decisions. It's become a huge investment organization around the world. It's not cheap, but it really is in a good position to be able to put money to work in this period of disruption. And they have been world-class at making good investment decisions. They have a lot of different structures like Brookfield Infrastructure, Brookfield Business Partners, Brookfield Renewable. So they've really been able to differentiate themselves and put a lot of money to work. They're very well regarded. So I think if you have a long-term view, it's a good one to keep an eye on. The thing to be aware of is that there's this concern about AI disruption and credit risks out there, and Brookfield does have exposure to businesses that they're lending money to and making investments in. So, and we've seen some weakness in some of the major PE firms in the States, like BlackRock and Blackstone and those kind of things. And Brookfield sort of held in here. So it just keep an eye on things. We're into a volatile period where opaqueness, and Brookfield can be opaque. It's a difficult thing to keep track of. When people get nervous, you can have problems.
So something to watch for.
Yeah.
Okay, we're going to go to the phone lines now. We've got Peter calling in from Niagara Falls with a question. Hi, Peter.
Hi, good morning. Thank you for taking my call. My question for John is on Manulife Financial. I just added it to my portfolio this morning on the market sell-off, and I would like his outlook on the stock. Lindsay, can I have the street estimate? Thank you. I'll hang up and listen to your answer.
Yeah, sure. Thank you.
Hi, Peter. Well, good for you first for putting money to work this first thing this morning. We did the same thing. We bought some JP Morgan and some other stocks this morning. It's always usually a good thing to take advantage of short-term panics. Manulife has been turning the corner. It's got a good dividend yield. It's finally starting to get some traction. These higher interest rates are allowing Brookfield to start earning a better return on its bond portfolio. There still is some dislocation, obviously, in the real estate portfolios that they have. But Manulife's been doing a good job of growing its business, and I think at these prices, it's trading at a reasonable valuation. And as people worry right now about credit quality in portfolios, Manulife is probably less exposed to those kind of things. So you're sort of avoiding that problem. So I think Manulife's a good long-term investment. We don't own the stock ourselves.
Okay, and also 68% of consensus there say it's a buy, 18% a hold, 12% a sell. So hopefully that answers your question. We'll move on now. Elliot's calling in from Hamilton with a question. Hi, Elliot.
Good afternoon. I'd like to add a global financial to my RRSP, and I've been looking at Santander, SAN, and Citigroup C. Would you prefer either or neither, and why? Thank you.
Thanks very much.
I think if I were to go with one of the two, I'd go with Citi. It's been slimming down its foreign operations, but Jane Fraser, the CEO, seems to be doing a good job of turning the operation around. It's taken, since the great financial crisis in 08-09 to really get this ship righted. It's trading at very reasonable valuations, I believe. It's trading close to book value now, so it's trading cheaper than the other banks. There's still some suspicion. Bank Santander has been a very good, well-managed bank. There's a lot of exposure to Latin America, South America, and also into Europe. So I think it's one that if you wanted to have sort of more, really, truly more international exposure, that's the one that I would go with. But, it's going to be more volatile because it's dealing with more sort of, I don't want to use the word third world countries, but economies that tend to be a little bit more cyclical in nature. And so that's, that would be my concern. But I think you're right to be looking internationally. That's where a lot of people are talking about. The one thing I would temper that with is there's a great deal of talk about, the loss of American exceptionalism and all that kind of stuff. And I just think that's people that are angry at America about what's going on, less so about the businesses that are being run and the entrepreneurial spirit that's in America. And we're still seeing pretty dynamic operations in the States.
So while you think it's maybe a good idea for people to diversify internationally, don't leave the U.S. altogether, is what you're saying.
Yeah, the way I would look at it is I think out of the S&P 500, there's around 60% of its revenues or so are international.
Yeah.
And I've been in this business for, I don't know, a little over 40 years now. And people are always saying, oh, go international. And I think that's just the investment community trying to get you to do something because they make a living when people do transactions. And I'm sort of somewhat skeptical. Europe's very heavily regulated, and America is sort of really deregulating. The banks in the States are very, very well capitalized. We'll talk about it a bit later on.
Mm-hmm.
So I don't think you need to necessarily go international. Somebody's telling you to do that. There's been a lot of false starts.
Interesting. Okay, we'll take one more question before we go on a break here. John is calling in from Waterloo with a question. Hi, John.
Hey, how are you guys?
Good, thanks.
Hey, John, I want to get your opinion about Devon Energy on the New York Stock Exchange, please.
Yeah, they've all had a big bounce. They're probably getting a good bounce right now, and I don't know if my commentary is going to make the Globe and Mail or not, but I said today might be a good opportunity to take profits in both gold and oil because this is probably the peak of uncertainty with regard to supply. You need energy prices at around $75 to $80 a barrel over the long term for these energy companies to make significant profits. It's a very, very difficult business. It's very expensive. It's not getting any easier. And if you really look at the what's been going on, the global oil market is really somewhat oversupplied. That may have a temporary glitch here, depending on how long this altercation takes place in the Middle East. So I wouldn't, these kind of prices are necessary for these businesses to be really compelling long-term investments. And I don't think that it's reasonable to think that we're going to have energy prices $75 or $80 for an extended period of time. So I wouldn't bet on these kind of prices for long.
Okay, we're going to take a quick break right now. We'll be back, though, with John O'Connell of Davis Rea taking your questions on North American large caps. Here's how you can reach us. Welcome back to Market Call. John O'Connell is on the show today taking your questions, and we'll go to the phone lines. Kevin is calling in from Kingston, Ontario with a question. Hi, Kevin.
Hi, thank you for taking my call. My question's on the TD Bank. It's had an incredible run from the low 70s almost a year ago, and here we are now pushing in the mid 130s. I'm just wondering if you see more upside. I know they had a big problems in the United States with money laundering, but I think they paid the penalty. And so with long-term rates still high, I just wondering if it's worth buying some more at this price. Thank you.
Okay, thanks for your question.
Sure, Kevin, thank you. It's complicated. First, the Canadian bank stocks are trading pretty rich compared to their U.S. counterparts and trading at bigger multiples to book value than a lot of their American counterparts. TD Bank did, in fact, pay the penalty, the financial penalty, but they're still paying huge in terms of their ability to grow in the States. And I would expect that those problems will persist for a while, and that was really TD's growth strategy. Wells Fargo took, a long, years to get out of the purgatory that the Federal Reserve Board put on Wells Fargo. This is a Canadian bank. We're entering into negotiations with the Americans, and I can see TD Bank being caught up in that kind of a problem. I would expect that kind of regulatory burden on TD to continue for quite some time. So I think if you wanted to have a Canadian bank, if you needed to have a Canadian bank, I think I'd be more inclined to go towards, let's say, a Scotia Bank, which seems to be cleaning up its act in South America, for example, or the gold standard's always been Royal Bank, my old employer.
Okay, back to the phone lines now. Chris is calling in from Delta, BC with a question. Hi, Chris.
Oh, good morning, Lindsay, and good morning, John. John, I just would like to say quickly how much I've always appreciated yours and Christine's thoughts and guidance over the years.
Thank you.
Absolutely. And I'd like to ask you about CNQ, and I know you've already spoken generally on oil, that it might come to take some profits. CNQ is, along with Pembina Pipeline, are pretty well 10% positions, my top two positions in my portfolio. And as a 30-year-old long-term investor, I'd love your maybe thoughts on that, and if you would maybe rebalance that at all. I will hang up and listen. Thank you so much.
Sure. Thanks, Chris, and I appreciate the comments. That's very kind of you. CNQ's best-of-class operation, and they're a very disciplined management team. They won't just go out and acquire something unless it makes economic sense for the long haul. They have really concentrated their position in the oil sands in a very disciplined way. They have massive natural gas reserves that I think if Canada can continue to walk the talk about gaining more international exposure to global markets, CNQ is really, really well positioned for that opportunity. So I think if you wanted to have one, well, that's the right one to have. Realizing that the oil and gas business is highly cyclical. So, I think that this is probably peak uncertainty, as I said. So if it's 10%, I don't have a problem running concentrated portfolios, Chris. I think it's wise. That's the old-fashioned way, and it works. But I would use this as an opportunity to look for some areas that have gotten really beaten up and maybe some international exposure. We'll talk about that a little bit later on. Pembina, great operator. We own it. Christine owns it in her portfolios. I think they need to raise some equity here fairly soon. So there's been some downgrades recently. They've done an acquisition. They're going to have to finance that fairly soon. So I would, once again, good operator, good dividend yield. I love the long-term investment approach.
Okay, we're going to go to an email now. This is coming in from Rachel, and it reads, could I please get your thoughts on DraftKings?
Well, I've been following it, and I was very interested in it. And it's a really complicated business. It's changing very dramatically right now. You got these prediction markets that are offering a very competitive way for people to lose their money. And in the end, I don't know what's going to happen here. They should have some incumbent advantage, but people are adopting Kalshi and poly markets at a very, very rapid pace. They are interesting markets in many, many different ways. So it's a very competitive environment. There's also a lot of regulatory fragmentation across America in terms of how these gambling sites work. And finally, the thing that really turned me off about DraftKings and Flutter, for example, the big betting platforms, is they can cut you off. And I think if you're a successful gambler, they will stop you from being able to place bets. If you're not a good gambler, they will encourage you to gamble more. And I can see that at some point becoming an issue with the regulators in terms of a predatory market and being unfair. And I just think that's it was a warning sign for me saying, oh, you only let people lose money here, and you don't let winners win. Whereas the poly markets, there's potential problems with them. There's, betting, inside betting and all that kind of stuff. That's a very interesting argument in its own right. So it's fallen a lot, but just because a stock has fallen doesn't always mean that's a good investment. I'd just be really, really careful.
Okay. Another email now, this one coming in from Ryan, and it reads, Uber has had a pretty bad ride lately, pun intended. What are your thoughts on Uber going forward?
We've studied Uber. We owned it briefly when it got really beaten up recently. We made a quick 10 or 12% and we moved on. I think it should be a good player. It should survive. People are worried about disaggregation of Uber based on autonomous driving. And I was in Scottsdale recently and took an autonomous card, a Waymo drive. It was incredible. I don't think all Ubers are going to be autonomous, and I don't think it's going to change all that rapidly. There's still lots of problems, particularly about the economics of autonomous driving. Those cars are very expensive. Uber has a very interesting model in that the driver is the one that bears the cost of owning the car and the insurance and those kind of things. Autonomous starts getting those cars become property of Uber, and that's a much more capital-intensive business. I would imagine the costs will decline over time, but still, Uber's trading at pretty reasonable valuations. I think the management team's done a really, really good job. It's not expensive. It's just like I feel like a kid in a candy store right now with software companies. There's a really wherever there's the fire and there's the panic, that's where the value is. And it's not in energy stocks right now.
Yeah.
So I think it's an interesting one. I think if you're a long-term investor, they should be a winner.
Okay. We're going to take a quick break right now. When we come back, though, we'll take a look at some of John's past picks. So that's next. Stay with us. Welcome back to Market Call. We're going to go through some of John O'Connell's past picks now. So these are from January 14, 2025, so over a year ago. We'll start with your first one, which is Meta. It was recommended at $594.25. Now it's $655.47. It's a total return of 10%. You still holding this one?
Yeah, I love it. I'm disappointed that it's only up 10%. I mean, it was up a lot more. This is part of the AI hysteria panic going on. It makes no sense to me that Meta is growing at 30%. One of the most dominant, profitable companies in the world, run by a guy that may not be liked all that much, but is one of the most innovative business people in the world. He's fearless, trading at 19 times earnings, less than a market multiple, growing at almost 10 times the market. Caterpillar trades at 30 times earnings, growing at 4%, because people are buying the data centers, the generators that Caterpillar makes and the tractors. I just think this is another example of economics upside down, and people are worried about it's in the price. Yeah. I think it's trading at a very, very reasonable valuation. It's got good balance sheet. They're spending a lot of money. They can afford it. So can Amazon. So can Google. So can Microsoft. If they don't make these investments, then they are at risk. And as Mark Zuckerberg said in the last conference call, he's not prepared to take the chance that someone's not going to let him access a data center to run his business. So he's going to have his own, and he's going to develop his own technology. That's forward thinking. That's protecting your franchise. And these new entrants that are going to put these guys out of business, they don't have access to the power or the data centers like Amazon, Meta, Google, and Microsoft do. So I think there's a big, big upside down moment here.
And you say, you're going to have to wait and see whether these companies can actually show results for all this spending.
But they are. I mean, their earnings were up 30% last quarter.
So that's what I was going to ask. Like, how long do you wait to see these results? But I guess they're already coming in.
They're already coming out. This is the bizarre thing. I mean, Microsoft's their cloud business grew at 38% last quarter, and the investing community was disappointed because it only grew at 40%. And Amy Hood, the CFO, said, I could have grown it at 40%, but we need some of the data center stuff for our own internal uses as well. That's common sense. And the stock fell it's down 20%. And it's trading at like in the low 20 multiple compared to stocks that are trading at 30 times earnings that are growing at nothing. It's bizarre.
Okay, your next one is Synopsys. So when you recommended it was at $490.36. Now it's at $412.05. So this one down a bit. Are you still holding Synopsys?
Yeah, we bought more down, lower than it is today. You cannot design a computer chip without Synopsys. And they acquired another company called Ansys last year. And they just bought $250 million worth of their stock today, by the way, buyback. You cannot design a computer chip today without Synopsys. You cannot design a data center or a car factory or any industrial application without using their software to design it, test it virtually, and see if it works. This is the ultimate AI play. They are a dominant player along with another company called Cadence, trading at half the multiple that it used to trade at, growing exceptionally quickly. It is a fundamental core company to everything that's going to happen in the future. And I think it can be a very volatile stock. We've owned it for 15 years. It's great business.
Lastly, Alphabet is your last past pick. This one's done quite well so far. So recommended $189.66, now at $304.61. We kind of talked about this.
So here's a classic example. A year ago, everybody was worried about Google.
Yeah.
lawsuits and AI, open AI is going to eat their breakfast and all that kind of breakfast, lunch, and dinner. And today, analysts can't get enough of it. Like once somebody earlier said, I want to have analyst opinion, it's always buy. And so now people are worried about Meta and Microsoft. And so 2 years from today, Meta will double and Microsoft will double and Google will have some kind of a problem. It's just secular rolling around by high-frequency traders and people that are worried about the narrative today. Google is in a great position. It always was in a great position. It was trading at 18 times earnings, just like Microsoft is today, growing at incredible paces. People were worried that these companies cannot adapt. They are the most adaptive, well-managed businesses historically. They're good value. Google's a little bit pricey right now. It's not as cheap as the other ones, but it's in a really, really good place. And OpenAI is struggling.
Yeah. Okay, we're going to take another quick break right now, but we'll be back with John O'Connell of Davis Rea taking your questions on North American large caps right after this. Stay with us. Welcome back to Market Call. John O'Connell is on the show today answering your questions, and we'll go to the inbox. We've got an email from Sam, and it reads, "Hi, Mr. O'Connell. What do you think about Netflix? Is it a buy at this price?"
I think so, Sam. When they announced the takeover of Warner Brothers, and the stock fell by 20% or something, once again, you always look where the disasters are, and it kept falling and falling and falling, and we kind of thought, if it got to a certain price, they'd walk away and the stock would go up. They kept saying they'd be very disciplined about buying the company, and the street just kept selling it and selling it and selling it and selling it. And we just kept buying it all the way down. We built it up to about a 5% position. Our cost is around, I don't know, like 85 or something now. It's a great company. It's got a fantastic library. It's a shame they didn't get Warner, but it's not the end of the world. As Sarandos, the CEO or the co-CEO, said, I think this weekend, given the history of Warner Brothers, we may end up owning it eventually at some point because Paramount is going to be massively in debt, and they're going to have to make major cuts. But I think Netflix is in a really good position here. They are going to be able to spend and probably buy lots of product from Warner Brothers to put onto their platform, because Warner Brothers is going to need Netflix to distribute, and they're going to need money to produce films. So I think it really is the best of all worlds. And quite frankly, Warner Brothers is going to be crippled with debt. So I think Netflix is in a really great position, and it's trading at 30-40% cheaper than it was 4 months ago. And its profits are growing. So I think it's in a great position.
Is that why? Because you like watching market reaction since Netflix announced it was walking away from this deal. It's been going up.
Because that's why it was going down.
Yeah.
But if you had a view that if they're smart business people and they make a reasonable decision, a rational decision about buying this, and they kept saying, we are going to be very disciplined about this. It's a nice to have, but it's not a must have. So listen to what they were saying. And Paramount was hell-bent. They needed to buy it or else they really were in trouble. So I think Netflix, there's a rumor, and you can't disprove it, that they actually pushed Paramount so much because Paramount's going to be beholden to some extent to Netflix. So
Interesting.
It may be it may be a movie all in itself.
Okay, we're going to go to the phone lines once again. Jim is calling in from Elliott Lake, Ontario with a question. Hi, Jim. What's your question?
Hi, good afternoon. John, just wondering about Dollarama. It's had quite the run, obviously, but where are we at right now with this stock?
Okay.
It's been a wonderful long-term investment, Jim, and you're quite right. It's pricey. They import a lot of stuff. There's a lot of people in financial pain, and Dollarama, has been moving a little bit more up market. You get to a point where, I don't know how many more stores they can build. I haven't looked at it in a while because it became very expensive, and I tend to focus more on U.S. equities. Christine has a little bit more of Canadian bent. We do not own the stock. I think I'd be cautious here. What are they going to do to keep the growth momentum going? And are they going to expand down in the States? And the history of Canadian companies expanding in the States is not necessarily, riddled with success.
Yes. Okay. We've got an email now from Michael, and this one reads, what does the guest, John, think about Newmont and gold in general? Newmont first, maybe?
Sure. Newmont, gold, Newmont, it's all kind of the same thing. It's had a great run. Gold's had a great run. And it's interesting that it's down today with gold up, back up at old highs. Like I said in my commentary, which if you want, send me an email, I'll send to you. These are the kind of events where you sell the spike. And look at the chart. It's gone from, 40 to 127. Yeah. We had a client that had a small legacy position. We sold half of it last week, and I think we sold the rest of it this morning. So I wouldn't be. Gold it's a funny market, and I don't really understand how it gets priced. It's trading materially above its average cost. There's been some foreign buying of it. Central banks have been increasing its demand, their purchases around the world, but it's a very small amount of what central banks have actually been allocating their resources to. They still by far own way more U.S. treasuries, and foreigners have not been selling American assets. They bought $1.15 trillion worth of American assets the last 6 months. So I don't, there's always a reason to buy gold. There's gold bugs out there. I respect that. There are so many alternatives now, and there's so many different ways to make a living. And there's so many things that are down 30 or 40% that, to my mind, look like compelling valuations. Good
opportunity. Okay, we're going to take another break, but we will be back with John O'Connell of Davis Rea taking your questions on North American large caps right after this. Stay with us. Welcome back to Market Call. We are going to take more questions from John O'Connell, so we're going to go straight to our email. And we've got an email question coming in from John, and it reads, can I have the guest thoughts on UPS? So, John, what are your thoughts on UPS as a company?
It's been struggling for a long time, and it's a very capital-intensive business, and it's got, they went through some brutal strikes. They've had to raise wages a lot. I think they're behind the eight ball compared to, let's say, an Amazon, who's a much more efficient logistics business. I think I would stay away from it. I just think it's a very, very competitive business. It's once again, it's like one of those stocks where it's fallen up, but it doesn't make it a good business. And it's a very competitive business. There's FedEx, there's Amazon, and UPS, and I just don't know. And particularly if energy prices do stay higher here, it's going to be a problem for them. And also, this tariff mess has been a huge problem for these kind of companies. So who knows how it all works out? But I go with Amazon. Cheap, 19 times earnings.
Yeah. Okay, we're going to go to another email. This one coming in from Rob, and it says, do you prefer Mastercard or Visa at current price levels, or are you favorable for both? Do you have a preference?
I think they're all kind of interesting. We'll talk about one of them, an alternative as a top pick, but they've all fallen because the AI monster is going to take them away. I think they're both interesting. We own Mastercard. Christine owns Mastercard. Christine's a smart cookie, and I think that they both have durable long-term franchises. And it's very difficult to mess with the payments system. And these guys have incredible ability to invest in technology themselves. And I think they will. They have always invested in technology. And it'll be unusual to see, I think, these companies be disrupted by new entrants. But I'll talk about an alternative investment.
Yeah, we'll get to that quite soon. Okay, we're going to go back to our inbox because Jeff has an email for you, and it reads, "Hi, what do you think about S&P Global at these levels? Is the fear surrounding AI exaggerated for this company?"
Yes.
Talking about this quite a bit, yeah.
Christine owns it in her fund. I was joking with her that she actually has a stock that went down 20%, which is an unusual occurrence for Christine. I think it's very cheap. But this is a boogeyman under the bed syndrome. They are a massive purveyor of the historical data, and they are a data-driven company, and there's no reason to think that they will not be able to adopt new technologies and sell it into their already diverse and deep distribution system, along with the reputation that they have as quality providers of information and data. So I think actually AI is a tailwind, not a headwind for their future.
Okay, another email now, this one coming in from Jimmy, and it reads, "What are your expectations for Robinhood? Is Bitcoin doomed?"
I don't know about Bitcoin. I do know that blockchain technology is going to be an important aspect of the continued technological evolution of transferring information and data across wide parts of the industrial world. Bitcoin's a speculative asset that I don't think has a lot of industrial or real financial uses. The number of transactions that can get done on Bitcoin on a daily basis is pitiful when you need billions of transactions a day to make these things economic from a business perspective. Robinhood's really interesting. We bought some a little while ago and sold it when it bounced. We don't normally do that, but once again, you see these dislocations taking place. The CEO is very visionary. They've built up a real business, and they're morphing into wider areas. They're getting into prediction markets along with Kalashi, I believe it is, or Polymarket, one of the two. It's a very innovative financial services company, and they've got a lot of customers. They've gone through a bit of a hiccup recently. It's not just because of AI. When you have these highly valued companies and they go through a hiccup, there can be problems. So I think I sort of wanted to be interested in the very low 60s.
Okay, we've got enough time for just one last question, so we'll have to be quick with it. But it says, this is from Patricia, and it reads, "Good day. I'm interested in what the guest thinks about Ford as a company."
So we don't own car companies as a general rule. It's highly cyclical, very capital intensive, difficult. They're all getting massacred because of the shift to EVs and out of EVs. It's just a mess. A lot of people are in pain, and it's a very bifurcated economy. There's some people are doing very, very well, and there's a lot of people that aren't doing very well. The car business is a very competitive business and very capital intensive, and I just don't think it's really an attractive area. It's highly cyclical. We try to stay away from cyclical investments.
Got it. Okay, we're going to take another quick break right now, but when we return, we will take a look at some of John's new top picks, so stay with us. That's next. Join us tomorrow on Market Call. Keith Richards will be on the show. He is President and Chief Portfolio Manager at Value Trend Wealth Management, and we'll be taking your questions on technical analysis. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. And time now for top picks with John O'Connell. So we'll go through these. Your first one is JP Morgan Chase. What do you like about this company?
Well, it's down 15% from its highs. It is the blue chip bank around the world. People are worried about AI disruption. JP Morgan will spend $20 billion on technology this year. That's more than most regional banks are worth. And they've demonstrated a strong track record of making investments in technology for years and years and years. They're a front runner there, trading at reasonable valuations, about 12 times its earnings, cheaper than Canadian banks, but a 2.5% dividend yield, I believe. Credit quality, fantastic. Earnings growth, hugely overcapitalized. So I think you can see buybacks, dividend boosts. So it's a cheap stock and a great franchise, very well managed.
Next up, we were talking about this, or teasing this, I guess, earlier, American Express.
Yeah, so American Express is a bit different from Visa or Amex. I mean, it's fallen because of this AI thing. And you know, first, they have years and years and years of data on their customer, whereas Visa doesn't really have the same thing with their customer and the merchant. Amex has the data on both sides. So it is a company that actually should greatly benefit from AI. It's trading at very reasonable valuations. It's fallen by, I don't know, 30% or so in the last 20 months. So we've just, in the last 12 months or so, we've just originally started allocation. We bought some more again this morning. I think we're doing the same thing we did with Netflix, just buy it on the way down. They keep getting cheaper. It's a better value opportunity. But it really has all the data on all of its customers on both sides of the transaction. And so it really should be a major beneficiary. And people are worried that all the white-collar jobs are going to go away. I mean, there was this report that was written a couple of weekends ago by some citrus company or something. And the markets, these short-term traders, they do all kinds of crazy things, and the stock is cheap.
Okay. Lastly, Charter Communications.
So Charter Communications is kind of like, let's say, Rogers Communications.
Okay.
They're the largest cable company in America. They're buying one of their competitors out called Cox Communications. So it's down to about a $20 billion market valuation. It's fallen from $700. Its profits have gone up. And people, during COVID, the government in the States passed a thing called the Affordable Care Act, which meant that everybody was entitled to a cable line because it was deemed to be essential. You had to be able to work from home. So once COVID went away, those subsidies went away. So there's been a decline in cable subscribers. That's freaked people out. The rate of decline of cable subscribers has flatlined now. And so you're actually beginning to see, you're probably going to start seeing population growth recovering the cable things. It's trading at 4.5 times earnings. It's almost finished its capital cycle. The big concern was that AT&T and Verizon were going to build fiber to the home. Charter already is at the home. AT&T and Verizon are spending massive sums of money to build this cable. They will never be able to offer a service, given their debt loads they already have, at a competitive price compared to Charter. Charter has a non-cancelable contract with Verizon to provide wireless cellular service to its customers. That's growing very, very quickly off a small base, but it's growing. So this is like the convergence bundle that played out in Rogers many, many years ago, and Bell too.
Right.
And it's going to have, by the end of next year, it's got about a 30% free cash flow yield right now. So if you bought this company right now, you'd be making about 30% on your money every year. It's bought back half of its stock in the last 3 years. It's going private slowly. When the CapEx cycle is over at the end of next year, they're just going to keep buying back stock. And whoever's left is going to own all this free cash flow. It'll be 70% free cash flow yield in 2029. This stock is cheap. And we bought more under $200 a share. I mean, it was just kind of like, wow, sure. Like maybe it'll go to 100. I kind of, part of you don't want it to go lower.
Yes.
Part of you, if vegetables are on sale, don't, people still buy vegetables.
Yeah.
People still use cable. They still use cellular networks. They still use video on demand. This is a good company on sale.
Okay, we're going to have to leave it there, but appreciate you coming in today. Thanks so much.
Thank you.
And thank you for watching Market Call. We will see you next time. Trading Day is next.